So I think by late this year or by early next year, they probably would have pivoted their policy to some extent, especially post midterms. Right now, for example, they're releasing the Strategic Petroleum Reserve. That's obviously a finite thing that they can only do up till about the election. And it's something that they can't keep doing after that. So I mean, that's not a policy, that's a fiscal side. That's not a monetary side. In terms of monetary tightening, I think that, they can tighten until one of a handful of things happen. Either the treasury market goes illiquid, like it did in March 2020, or credits or repo markets encounter problems. Or you start to get a severe labor weakness with unemployment going up, say 100 basis points compared to it is now. And I think those are kind of the three things that could really cause them to have to pivot. And I would certainly expect that to happen before late 2023 and potentially by late 2022. So high debt levels and that whole idea of having to flatten debt away are a theme throughout most developed markets. So the United States, Japan, and Europe at this point. So that's global, at least for the huge areas of global capital. And then commodities are a global market. And so if you have years of underinvestment in energy capex, that becomes a global problem. And then it becomes an issue of kind of game theory, because let's say the United States, for example, prints a ton of money and gives it to people, and those people can go out and buy things and consume energy. If there's another country that did not print money, their energy prices are going to go up too, because the Americans printed. And so it becomes a global thing pretty quickly. So it spreads around because these economies are so interlinked, both in terms of their debt similarities, their financial connections, as well as the fact that global commodity pricing is a global supply and demand market. So I think the longer term trend is that all of these countries that have well over 100% public debt to GDP are going to be inflating that away over a period of time. But it does become a question of, is it disorderly or is it orderly? What is the order? Does one have to kind of go first? Does one have less room to kick the can down the road than another? Those become relevant questions. I think the ECB is in the most challenging spot because they have a more acute energy crisis than most other developed market areas, and they have a monetary union without a fiscal union. Right, meaning that they set monetary policy for the Eurozone, the ECB does, but individual countries have significant control over their own fiscal policies, more than, for example, U.S. states. And so that kind of fragmentation is it's a really challenging environment to operate in. And then you have countries like Italy with 150% debt to GDP, so they need assistance monetizing their sovereign debt. But then you have other countries that are like, wait, why are we doing that? Why can't we? That's not fair, for example. And so the ECB is just there's more moving levers there that can go wrong compared to the United States, and then even compared to Japan, in my view. So I think that there are some differences, but they also have the same general theme of too much debt, so it's not going to be fully paid back in real terms over the long run. I think partially, but I also think that in terms of just reality, governance is a vacuum. So governance fills, where centralization does not exist, it tends to move in that direction. One way I've been describing this whole era, meaning going back 100, 150 years, is that it's mostly a technological shortcoming, right? So because the speed of commerce due to telecommunications channels, starting with like laying undersea cables in the late 1800s and going from there, that basically allowed commerce to occur very quickly, whereas bearer asset money was slow. And so it got abstracted, centralized, arbitraged, and so it just became inherently centralized and controlled and political. And so I think that it's understandable that people are angry at that phenomenon, but in some ways it's the order of technology made that almost inevitable. And it's not a surprise that we saw that model spread to like every country in the world. And so I think it's more constructive to focus on technological solutions that can provide alternatives. Like if someone doesn't have an alternative other than you shouldn't do this, but the natural incentives are for people to do it, then it's just, you're going to kind of like be shouting into the wind. And so I do think it's true that, when you have centralized pools of power and they're human, and they have human levels of bandwidth dealing with something that's more complex than any of us can realize, billions of weekly transactions, for example, that there's inevitably going to be errors. And that longer term, I think it's about finding ways of using technology to decentralize things. I think, we might finally be at a point where we have technology that allows us to get around some of the hurdles we've had over the past 150 years of commerce moving faster than money. So I think that a lot of other things have some similarities to equities in the sense that if you try to remove the energy component, you're basically putting in more governance. A lot of them are more centralized, and so they end up looking like equity, like platforms that have some degree of centralized development. A handful of stakeholders that can kind of control the network, which in my view is a lot different than what Bitcoin does. So I think that the way I generally categorize it for a couple of years now is that Bitcoin is money. It's like a digital commodity, and that a lot of else what we see in the space is kind of these hybrids or these digital equities that might have value in their ecosystem and as serving a purpose, but they should just be thought of rather differently. So stablecoins are serving two significant roles right now. One is, as you point out, unit of account for a lot of trading platforms, either centralized offshore exchanges or in some of the DeFi markets, basically digital representation of dollars. It's still dollars. It's just like, I'm not talking about the algorithmic variety, but the actual fiat collateralized variety. Those are just dollars in this kind of, more efficient wrapper. And the second use case, the one that actually interested me more, is, people in emerging markets or frontier markets in countries with failing currencies. Stable coins are useful for them to hold for kind of intermediate term savings. So I had an Argentinian describe it to me very well. He's like, money that I'm going to spend in under a month, I'll hold in local currency. Money that I want to hold for several months, I'll hold in stable coins. And money that I want to put away for 3 to 5 years, I'll put some of that in Bitcoin. And so I think that there is, there's a demand for dollars globally, and stablecoins just happen to be the technology that it enables to allow them to get their hands on dollars. Like I said before, even if their governments and their banking networks are not making them available or trying to restrict access. So I do think that stablecoins have that purpose this decade. And that's why I also think that there's cool things like Taro on Lightning that could potentially bring stablecoins over to Bitcoin, and it just becomes whatever a network is most efficient to transact those dollars around, because those are less about pure decentralization and more about what can give people access to a cheap ability to access that foreign central hub of dollars. Central bank digital currencies are, I think, a whole nother thing entirely, where it's in many ways kind of the antithesis of Bitcoin. Those are more about centralized control, more about programming restrictions on how to use the money, and kind of even pre-programming like inflationary policy. And so I think that there are some countries like China that obviously are pursuing the CBDC route pretty rapidly. And then it's possible in the United States, you see other kind of public-private partnerships. Maybe a stable coin kind of gets treated as like a CBDC, because of course stable coins are vulnerable to regulation and control and regulatory capture. So I think over time those could potentially merge more in some of these countries that don't want to maybe develop their own CBDC. But I think it's still a very fluid environment at this point, and so it's hard to sort of lay out a direct course of how some of these things go.